The RMB Private Bank Segregated Equity Portfolio was founded in 2005 and has delivered a compounded annual return over the past 5 years of 9.12%. Suraj Sookdhew from RMB Private Bank joins us in studio for more. This is a pure equity play.
Yes.
And I see there's some interesting stocks in your portfolio, including a property play with Redefine.
Yes.
Do you think that that property momentum is going to pick up going forward?
Yeah, look, I think you've got to take cognizance of the fact that property has had a very strong run. It's been underpinned by this lower interest rate environment that we find ourselves in. And the fact that you're getting so little on cash deposit, I think the property stocks have found favor. And we think that we're still comfortable to hold on to our positions for a little while longer, but also cognizance of what the strong run we've had. And, you know, we'll assess that as we go along.
In terms of how much churn there is in the portfolio when it comes to your stocks and how long before you rotate, can you give us an indication of your investment philosophy there?
Absolutely. So if you look at our client base, it's traditional private clients that want to have a long-term strategy. So it's a buy and hold strategy. So we typically look at a 3 to 5 year holding period when we get into stock. Not to say that if we've made a wrong call that we can't get out of the stock, because we certainly can. But we typically look at a 3 to 5 year time horizon, and you know, we take tax considerations into account as well, given that it is private clients.
Are you happy with the return over 5 years at some 9.12%?
Yeah. Look, we think so, and the portfolio has done particularly well over the last 3 years. Even on a 1 year view, we think fantastic numbers versus our benchmark, which is the all-share index. And I think relative to the peers out there, we've done okay.
In terms of sectoral bias, where would you say that is most heavily associated?
So if you look at the last year, I think a lot of our strong calls helped us. We were massively underweight the resource sector. We were overweight the defensive healthcare side, defensive telecom side. We were in real estate, that helped us quite a bit as well. So we're still holding that position, although if you look at those sectors that I mentioned, both the financial and the industrial sector had strong runs over the last year. If you look at the charts, it's a big divergence between what the resources have done versus the other two sectors. So we think that there's value to be had in the resource sector, but you know, reluctant to get into that sector as yet.
Although you have got exposure, Anglo-American is way up there in your top 10, and so is Sasol.
Yeah, I mean, look, you've got to have weightings in the resource sector, even, you know, if it takes 3 to 5 years to
And BHP
to unlock.
is your second largest holding.
Yes, absolutely. No, we've got significant weightings in the resource sector, but relative to the index, we are massively underweight. And I think relative to our peers, we would argue that, you know, the market in itself is underweight the resource sector, and I think everybody's waiting to see when to switch into the resource sector.
Well, exactly, because the call right now is hurting you. Do you think it's going to turn around anytime soon?
Well, you know, if you have a look at the talk of further QE in the US market, there was talk earlier on that there'll be unlimited supply of QE. If that comes through, the buying of mortgage-backed securities, if that comes through quite strongly, we could see renewed interest in the resource sector. You know, you don't want to be caught short. You don't want to be the last one to be the buyer. But as yet, we don't have that sense of comfort.
5 year view on resources. Let's throw further afield.
Yeah, sure. I think you've got to be there. I think it's only a matter of time before you see a switching out of the defensive industrial, defensive financials into the resource sector. If you also look at bond yields internationally, you could argue that a bubble is being created as we speak, and at some point that bubble is going to burst and it's going to find its way into equities in developed markets as well as emerging markets, and you know, those resource counters can be a beneficiary of that.
MTN is your third largest holding. Currently, yesterday, looking at about 155 Rand. It has recovered much of the downside. It suffered over all the negativity and obviously in the press for the wrong reasons.
Yes.
Holding strong. I had Peter Takendesa from RMB Morgan Stanley in last night and giving his view on MTN. Again, he says he wouldn't buy it now with new money. Unless you've got a 4 or 5 year view, then he would be buying at current levels because, again, it's going to rally.
Absolutely, and we would agree with him. So if you look at MTN, when the story first broke out, it was trading around it fell to around the 130 level. That, you would argue, was a perfect buying opportunity, and a lot of the guys were thinking of switching out of Vodacom into the likes of an MTN. The one issue that we do have is that this negative press will stay as an overhang over the share price, over the share for the next
until
year.
we see a resolution, and it's not going to happen anytime soon.
And unfortunately, we might see further court cases that come through, but that's going to be an overhang over the company for the next year and a half. But if you strip out Iran and all this negative press, the company is still producing fantastic cash flows. It's got a fantastic dividend yield, and that's what you want to have or own in this environment where you can see the cash flows come through. So both MTN and Vodacom still a hold for us on the same theme: strong cash flows and good dividend yield.
Looking at your financial exposure, the only financial stock in your top 10 is Standard Bank. You're not delving into this a little deeper in terms of other exposure? Are they below your top 10?
No. So our preferred entry into the banking stocks are RMB and Standard Bank.
Oh, of course, it's your top pick is RMB Holdings.
Yes, that's right. So RMB has worked for us. Results we think will be good, the next set of results that will come through. Standard Bank has gone through a bit of restructuring. We think the benefits of that will be felt over the next year or two. Still a very strong brand, good presence in Africa, so they'll come through strongly. So we think that our picks in the banking sector has worked for us. We were fortunate enough to stay away from the likes of ABSA, which has been hurting recently, and we still. Did
you weigh up ABSA at one stage?
Yeah, look, I think
as a potential play.
Yeah, look, I think the market was looking for strong dividends coming out of ABSA, even a special dividend. We were toying with the idea of whether we should be switching. If you look at the results from ABSA, 6% drop in earnings is not a train smash, but I think there's questions about management and how you fill the gaps where management has, left the company. If that comes through, ABSA is still, a decent brand, and, further share price weakness, you might argue could be a buying opportunity. I
can see you eyeing this one with caution, but also with interest. Yeah. Life Healthcare Group. Is that your only exposure to the healthcare environment?
Yeah. So no. So on the healthcare side, if you look at the pharmaceuticals, we've got Aspen in that space. Then we've got on the hospital side, we've got Life Healthcare, and then on the medical aid side, we've got Discovery. So we like the defensive.
But Life Healthcare only one in the top 10.
Yes. We got in at the listing, and the reason it's in the top 10 is because it's had this fantastic performance. So we got in, fortunately, at the listing, and the share price, has gone through the roof. And we still think that there's still more to come out of Life Healthcare, and very comfortable to still hold on to it.
Well, you've actually answered my second question, because I was going to, if it's gone through the roof, isn't it time to get rid of it?
So we toy with the idea of maybe taking some off the table, but not selling it out completely. We still like the business case. We still like the environment that they're working in. We like that they're South African focused as opposed to the other two healthcare groups that are, in developed markets. So we think that there's still legs in that.
And there are those out there that are also saying that Discovery potentially and Aspen are also looking very frothy.
Yeah, look, I mean, again, strong runs in those counters. And, like I pointed out earlier on, if you look at the charts on the industrial, financial versus resources, it's gone, it has diverged. So strong runs in those counters, absolutely. We continually assess, whether we should be taking some off the table. But for now, the defensive theme still seems to be where you want to be. You want to see the strong cash flows come through, and we're still comfortable to hold on to that.
We need to also speak of Sabmiller. Again, it's got a front-running position in your top 10. It's the emerging market story, and the defensive nature of beer, I suppose.
Yeah. Look, also had a very good run, and we were fortunate to be in there. Also in the top 10 because of the big run in the share price. We're still comfortable. Emerging market exposure is where we want to be. Even British American Tobacco is one of our big picks, and like I say, emerging market stocks is what the international developed market investor is looking for. And those have benefited from that.
As you've pointed out, you're comfortable with your current positioning. Yeah. What would prompt a change? If you look at the current environment, the uncertainty globally, what would be a kicker for you to say, listen, we need to relook the portfolio?
It's a difficult question. So we don't have, for example, construction stocks in the portfolio. We're warming up to the idea of construction because at some point government has to spend, has to create jobs in the local environment, and that's the one place where they can do it. And at some point we'll look to get into one of those construction counters. The massive call would be the switching out of the defensive into the cyclical resource counters. What that kicker will be, or that indicator will be, is very difficult to say. We know that the QE from both the Eurozone and the US will be one of those kickers. But also you don't want to be too late, and therefore we do have positioning in them. Although we are underweight, we will look to increase that once we get that sense of comfort.
Suraj, always good chatting to you. Thanks so much for your time. Suraj Sookdhew, Portfolio Manager at RMB Private Bank.